So we're talking about entity choice. We said that a corporation is one type of entity. And there's a C Corp and also an S Corp. We're going to talk about the differences. But first, let's see if we can identify other entities. Because what we want to try and understand is the implications for the business. So executives, managers, they give a lot of thought and consideration to the type of entity. So what are some of the other choices for an entity?
Limited liability company.
LLC.
So, yeah, LLC, limited liability corporation. What else? What are we missing here? So corporation is, go ahead.
Sole proprietorship.
Yep, a sole proprietorship. And you thought just chalk squeak, right? Now the markers squeak too. Oh, I forgot I brought you guys something. Oh. Yeah, let me take one for myself first. I know the way you guys operate. So corporation definitely, and we're going to talk about the benefits of incorporating, because definitely there's an appeal to incorporating. There's certainly some disadvantages, but there's certainly some advantages to incorporating, and some organizations find that very appealing and advantageous. So a corporation, and you see there's different variations of corporations. C Corp, S Corp, limited liability corporation. There's also sole proprietorship. What else? Partnership. Good. Partnership. All right, so let's look at these. A corporation. What are some of the advantages of incorporating? Why is that appealing to an organization? Because we're talking about small business management, about entrepreneurship. We're going to start our own business, right? At the beginning of the semester, we said we're going to work as a team, and what we're going to do is we're going to put together a business plan. We said the main purpose of a business plan is to get investors. It's not our entire marketing plan. It doesn't include all the strategic components of our program and all the tactics. It's basically an overview, and we use it as a tool to get investors, to get people to invest in our organization. So we're going to have a marketing plan as well. Now the business plan is going to address marketing, absolutely, but it's not going to include everything about marketing. Just some of the key marketing components. At a minimum, we're going to talk at least a little bit about the marketing mix, which we often refer to as, what, the 4 Ps, which are product, price, place, and promotion. So we're going to address that. It's not going to give all the aspects of our pricing strategy or our promotional strategy and tactics. It's going to address some of them in the business plan. So one of the things that we need to determine is, as we put together our business plan, is what is the structure of the organization? Very critical. What is the structure of the organization? So we could incorporate. And actually it's easy to incorporate. In fact, the government deliberately has made it a fairly simple process. I could definitely show you how to incorporate. The form is actually 1 page. It's a form that's posted on the Department of State website. So if you go to the New York Department of State website, there's a 1-page form that you download there. and you could apply for incorporation with the state of New York. So it's not a complicated process. Sometimes you'll see ads, they say they'll incorporate you for $1,500 or $2,500. If you want to incorporate your business, regardless of how big it is or how small it is, come see me. I will help you. All right?
How much is the charge?
There's no charge. There's no charge. Well, one of the things we need to do, though, is to do a name search. So that's going to have an impact on whether or not we're able to become incorporated. So you need to do a name search first to make sure that there's not another company that's currently using that name. Now you could file an application also with the Department of State to get a DBA. What is a DBA?
Doing business as?
Right, doing business as.
You actually have right now a website. If you want to check with the name, they give you a response on the spot.
Yeah, yeah, absolutely. So you need to search for that and then submit your application for incorporation. The fees vary. The government changes the fees, but it's affordable. It's definitely affordable. Why do people want to incorporate? It's not that people don't operate as sole proprietorships. They do. And it's not that people don't operate as partnerships. They do. But why do people incorporate? We're going to talk about the other types of business structures. But first, let's talk about why do people incorporate? What's one of the main benefits? Now, there's also some disadvantages, too. We're going to talk about those. And you have to decide if the advantages outweigh the disadvantages. So what is an advantage of incorporating?
Maybe tax.
What was that? His lips were moving, and now you're speaking. I'm like, that's a pretty good trick. Go ahead, go ahead.
Or maybe tax benefits.
No, that's a disadvantage.
Yeah, well, generally, taxes, the issue of taxes is a disadvantage for companies that are incorporated. Let's see why. This is the issue as it relates to taxes. I'm glad that you brought that up. Actually, it's double taxation.
Yep.
Let me tell you why. This is what happens. We operate our business and we generate net income of $100,000. We have to pay tax on that money. Let's say that tax rate is 35%. So we have $100,000 in net income. Our tax so the amount of tax that we have to pay at a 35% tax rate is $35,000. So our net income is $100,000. That means we've already covered our cost of goods sold. Our cost of goods sold are our product costs. Those are going to include our product costs. And our product costs are going to include our direct materials, our direct labor, and our manufacturing overhead. The manufacturing overhead includes our indirect manufacturing costs. In order for a cost to be direct, it's got to be easily traced to a particular product. So that's why we refer to direct labor and direct materials that way, because the labor is something we could trace to a particular product. How many hours were spent making a particular product? That's easy to track. The materials, how much plastic that we use, or how much cotton, whatever it is, whatever the materials are, we could easily trace that or track that, tie that back to a particular product. But if somebody said, well, how much thread was used to assemble this suit? Well, if you said how much wool was used, then that's pretty easy to determine. You know how many yards of material that you used. But somebody said, how much thread? I mean, are you crazy? I mean, it's not that you couldn't determine that, but it would be very time consuming. And at the end of the day, what would you find out? That you used 5 cents worth of thread? So that's what we call an indirect cost. It's something that's not easily traceable to a particular product. Those indirect costs we capture as part of manufacturing overhead. So manufacturing overhead includes indirect costs. So in that case, it's going to include indirect materials. So we have direct materials, which is the wool, and we have indirect materials, which a good example would be the thread. An example of indirect labor would be the salary of the plant manager. That's also captured as part of manufacturing overhead. So we haven't forgotten about that, but the thing is, we have a plant manager for the entire plant, and we make 10 different products in an organization. Is that reasonable? 10 different products? We don't just make TVs, but we make MP3 players, we make gaming consoles, we make microwaves, make a lot of different products. So let's say at least 10. Well, the plant manager, let's assume in that facility, oversees all of that manufacturing. So you can't really say we paid the plant manager, let's say Elena was the plant manager. We pay Elena $200,000 a year. Is that okay?
I like 250.
250? All right. Well, talk to Yusuf. He's our contract negotiator. And you guys work it out and then let me know. So, how do we determine what percentage of Elena's salary is going to be applied to MP3 players? And what percentage is going to be applied to microwaves? And what percentage is going to be applied to DVD players and TVs? Now, that expense, that $200,000, maybe it might be as much as $250,000. That's up to you. I'm counting on you. You're going to work with Yusuf on this. Is that all right? All right, good. So that's going to be captured in manufacturing overhead. Now, there's a way, we're not going to get into that now, about how you could apply overhead costs. But let's not focus on that right now. Let's just say for now we're talking about manufacturing overhead as an indirect cost for both labor and materials. So the plant manager's salary would be an example of indirect labor. And those product costs are what we call inventoriable. Carice knows what I'm talking about, right? Yeah, it was a good guess. It could have been either Carice, Corinne, or Christina. That was a really good guess. Wow. Is it really? Wow. That was totally just a guess. Inventoriable. What are inventoriable costs? That means we have these expenses, like the one that we just mentioned. These expenses are not recorded as expenses, they're recorded as assets. So, in particular, when we're talking about direct materials. So when we buy material, when we buy the wool to make 20,000 suits, that wool shows up as inventory on our balance sheet, which is an asset, not as an expense. So what do? We debit inventory of wool and we credit cash for what we paid to buy the wool to make the suits. But then what's going to happen is when we sell the suits, then those costs that we've described as inventoriable costs, that's when they're expense. Why? What is the principle? What is the accounting principle that's guiding us there? What are we talking about? We're talking about matching, right? We're talking about matching sales with expenses. So the expenses have got to be recorded in the period that the sales were occurring. Does that make sense?
Same time.
Right. Is that correct, Carice? Did I say it correct? Good. And then what we do is calculate the cost of goods sold based on that information. Now this is the thing. After we determine our sales, and after we determine now the cost of goods sold, right? That's why I took you through that, because on the income statement we have sales, and then from sales we subtract the cost of goods sold, and then we subtract selling, general, and administrative, which are our operating expenses, and that's going to give us our net income. But then the government says, fabulous, and assuming that, remember when we prepare our financial statements in the United States, it's got to be in accordance with GAAP, which stands for what? What does this stand for?
General accounting something.
Yes. Generally accounting something is close. Generally accepted accounting principles, right? That's what GAAP stands for. Now the IRS has a different code. So a lot of times people joke about companies having two sets of books. Well, yes, companies do have two sets of books, because you have one set of books for financial statements, to prepare your financial statements in accordance with GAAP, and then you have the IRS code. So the IRS has different requirements in terms of how they're going to determine what the taxable income is. But let's just assume that we've done this in accordance with the IRS code. We've achieved a net income of $100,000, and we owe the government $35,000. We're left with $65,000. What are our choices as a corporation as it relates to that $65,000? Two things. Either we could keep the $65,000 as retained earnings. That's one choice. Or we could pay dividends. We don't have to pay the entire $65,000 in dividends, but we could use part of that $65,000 to pay dividends, and the other remaining portion will be retained earnings. So let's say that's $65,000. We decide that we have enough retained earnings. We're going to pay the $65,000 in dividends to our shareholders. Are we still in frame? Are we? Okay, want to just a little bit? Yes, go ahead, Khalil.
So initially you said it's double taxation.
Right. All right, now let me explain the double taxation. You ready?
No,
Yeah,
I mean,
share
the
house.
double taxation, what is it? Like, it's double the tax rate, so it was like 17.5 and it's now 35 or what?
All right, this is the thing. Now, this $100,000 is our net income. The company pays taxes. The corporation pays taxes. They're going to pay 35%. And that means that the company owes the IRS $35,000.
Yep.
Then, what's left is $65,000. We then distribute that to our shareholders.
Then they're gonna pay taxes again.
Oh.
Now the shareholders, when I give the money to Benita, and when I give the money to Yusuf and to Christina, they're going to have to pay tax. And their tax rate might be only 28%. Now, the reason why we refer to this as double taxation is because it's the same $100,000.
Tax twice.
We paid taxes on it. The government got $35,000 from our company. Now all that we're doing is we're taking the remaining $65,000. We started with $100,000. We gave the government $35,000. The other $65,000 that's left after we paid the taxes, we just decided we're going to now give it to our shareholders because they're the owners of the company. Government says, you can do that. No problem, man. But the problem is that when I give the money to Benita, the government says, now Benita has to pay tax on that money. Well, what do you mean? This is the same money. All I did was now give it to Benita. If we kept it as retained earnings, that's the end of the story at that point in time. But if we then decide to, you know what, not keep it as retained earnings and give it to the shareholders, government says, okay, as soon as you give it to Benita, then Benita has to pay taxes. So you're paying taxes twice on the same money. This is the same $100,000. The company paid $35,000, and then how much is the tax on this? What is that?
2%, 62.
How many thousands of dollars is that? Come on, where are my whiz kid grad students here? Come on, help me out. How much is that? 28% of $65,000.
18,200? Something like that.
$18,200? Not pesos, right? $18,200. Now, if we operate in Mexico, it might be pesos. That's another issue that we need to address if we're going to operate as a multinational corporation. So, the government got $35,000 from us, and then $18,200. So the government ended up with the corporation earned $100,000, and the IRS ends up with $53,200.
More than half.
So actually, Khalil, instead of it being like 17.5%, it's more like 53%. That's the disadvantage of incorporating. That's the main disadvantage of incorporating. And that's what we refer to as double taxation.
What about the multinational corporations? How they tax it? The same level rate also?
Absolutely. So in most markets outside of the US, you're required to pay taxes. In fact, I was just looking at the financial statements for Procter & Gamble. That's my stage director. For Procter & Gamble, and they paid to international authorities last year, well, actually, they're on a fiscal year, the 2011 fiscal year, over $1 billion to international taxing authorities. They had deferred taxes of about $250 million. which is on their books as a deferred tax liability. And I believe that they paid almost $2 billion in taxes to the United States government. So absolutely, in many markets.
But then when they pay out the dividends, the shareholders still gotta pay taxes too, right?
Like, how is that tax affecting them? Why do they care? Like, why does the corporation care if people being paid out getting taxed? Why?
Because the owners of the corporation are the shareholders. So you have a management team that are running the company, but who really owns the company? It's the people who have the shares in the company.
What is only one owner?
Then,
But in corporations, it's two or more people, so there's never ever one owner.
all right, so this is the thing. So my suggestion is, and we're going to come back, I want to talk about the advantages of a corporation, but my suggestion is that if you have a limited number of shareholders, what I suggest is an S corporation.
Yep.
The reason for an S corp is because the IRS says that if you have a limited number of shareholders, and the IRS has changed this a number of times, the IRS code has changed a number of times in terms of the number of shareholders that meet the criteria for an S corporation. So at one time it was 50 shareholders or less. Another time it was 75 shareholders or less. And I believe currently it's 100 shareholders or less. So if your company, if your corporation has 100 shareholders or less, then what we could do is file this one-page form with not the Department of State, but with the IRS. So we're still a corporation, but the IRS has the authority to determine how our income is going to be treated, how it's going to be taxed. And so if we file this application to be considered as an S corp, then what that means is that we won't have double taxation. So the government says, we understand, we know why you want to be incorporated, and we're going to talk about that, what the main advantages are. So that means that what happens is this $100,000 in net income is going to flow through to the shareholders on an IRS form known as K-1. And the K-1 is an IRS form that lists all the shareholders and their social security number and how much the company, because remember, this is the corporation, whether it's owned by 1 million people, right, if there's 1 million shareholders, or 50 shareholders, the K-1 is going to list the shareholders, their social security number, and how much of the net income they were paid. So if you have 50 shareholders, the K-1 is going to list those 50 shareholders, their social security number, and how much they were paid. Then you have to pay tax on that income. So if, Yusuf, if we gave you $10,000 out of the $100,000, then you're going to have to report that on your personal income tax and pay taxes. Not the company, not the corporation. So the corporation is not going to pay any taxes.
That's an S corp, right?
That's a
Right. That is an S corp. But we have to apply with the IRS, and it's not difficult. It's one-page form that you apply with the IRS, and it's basically, it just comes down to how many shareholders that you have. That's one of the main criteria.
You need approval.
Right. So it has nothing to do with the Department of State. Well, as far as they're concerned, as far as the Department of State is concerned, you're a corporation. But then there's this issue about taxation. So the IRS has the authority to classify our corporation as an S corporation. And if that's the case, then we avoid double taxation. But you have to have presently less than 100 shareholders. 100 or less shareholders. So if you have 100, that's okay. 99? Okay, that's even better. So what is an advantage of incorporating? Why would people even consider, like Kip was saying, why would you even consider this if you have double taxation? What would be the advantage?
The main advantage, it is a separate legal entity, basically.
Liability.
If you get sued, they get
So
sued.
you got, what is it, unlimited liability? Or limited liability?
You have limited liability. So us as a shareholder in the organization are protected. So when we incorporate, then what happens is we're shifting the liability from ourselves to the corporation. Then the corporation is responsible. If money is owed to suppliers for the wool, for the suits, or plastic, or leather, whatever it is, then the corporation owes that money. If the corporation doesn't pay, they can't come to Khalil and say, well, Khalil, you're the vice president of sourcing, so you pay. Because right now you owe us $347,286, and you're the vice president of sourcing, so why shouldn't you pay? And by the way, you're also not only part of the management team, but you're a shareholder in the company. And you say, no, talk to the hand. That debt is owed by the corporation, not by you, not by the president. Now that's different as a sole proprietorship. As a sole proprietorship, when you sign that receipt, then you're responsible. You're the president. You can call yourself, give yourself whatever title you want as a sole proprietorship, whatever.
Sole proprietorship.
We're talking about a C Corp, a sole proprietorship now. You're responsible personally, so that if money is owed for the merchandise, you're personally responsible. That means they can sue you. Not the corporation, because there is no corporation. So they're going to sue the owners of the company. And it's possible, although generally it is against public policy, that the court might award personal assets. Which means that if you owe suppliers a lot of money, and you own 5 homes, and of course you've got to have a different Mercedes at each house, right? I mean, of course. Then the court is going to decide, in that case, that more than likely that's extravagant, and that you should pay out of your personal assets what's owed. If you have one house, it's unlikely that the court would do that, because everybody's entitled, courts generally believe that everybody's entitled to a minimum standard of living, and okay, you had this business and you owed this money, but that doesn't mean that you should go homeless because of that. So then the court offers some remedies, like you could file for bankruptcy, which is legal. And in the United States, usually about 1 million people file for bankruptcy in the United States every year, especially in the last several years. That's been the case. But as a corporation, you have limited liability. You could sue the company, and you might end up owning the factory. But you can't come back to the president and say that the president owes you the money. Now, of course, you're probably going to sue the president anyway if that was the case, but the president can't be personally responsible for debts of the company. However, there is a possibility that even if you're incorporated, that a claimant could, what we call, pierce the corporate veil. So that's really what we're talking about, is this corporate veil. So the corporate veil means that as shareholders, we're covered in this veil. We're covered in the corporate veil. Like if I was hiding underneath this, right? I hope nobody I know is watching this video. But basically, that's when we incorporate, that's what's happening. Is we're now covered under that corporate veil. And we're protected. Our personal assets are protected. Unless, not that you're negligent, because sometimes we are negligent, which means basically that we're careless. But if we do something that is considered to be malicious and intentional and horrible, then the court could say, you know what? We're going to allow the claimants to pierce the corporate veil. That means you're no longer protected by the corporation. That you should be personally responsible. So it's not like you just have like this get out of jail free card where you could do whatever you want. No, and we've seen that. We've seen how executives in an organization who aren't even shareholders, well, probably that's not the case. They probably are shareholders. They do, because most executives get stock options and are given shares in a corporation to provide them an incentive for the company to do well. So if the company does well, the stock price is going to go up. And if they have stock in the company, then they're going to become more and more wealthy. So in that case, they would be shareholders, but the court said, well, that doesn't really matter. Like when we look at these corruption scandals at Enron, and what would be another good example? Oh, there's a lot of them. That's so important that you guys know. I mean, there's been a lot of accounting and corruption scandals at companies in the United States. Executives actually went to jail.
There's one that's going on right now. The guy was a part of he was a senator or something like that, and he became this. Something to do with the company. They're doing a review of the entire case. It's going on right now.
Yeah, there's quite a few companies that have executives that have done things that are either unethical or illegal and have gone to jail because of it. Right, exactly. Bernie Madoff is an example of corruption.
KBR.
Yeah, absolutely. So they weren't protected by the corporation status. Even though Enron was a corporation, they weren't protected by the corporate veil because the court said, no, what you did was illegal. What you did was inappropriate, and therefore you don't have protection. It wasn't negligence, it was deliberate, it was intentional. You committed fraud. So that's important clarification. I don't want to leave you with the impression that you could all hide under my jacket, because you can't for a lot of reasons, right? But certainly you're not going to have protection from the corporation if you do something that's inappropriate, illegal, for example. But that being the case, if you operate your business in a legal manner, in an ethical manner, you might make mistakes, accidents might happen. Let's say, for example, you operate a store and we sell clothing there, and people are walking in and out during the winter, and they track in snow, and then the snow melts and it turns into water, and then somebody comes in and slips. Right? So we didn't do anything wrong. We weren't out there trying to hurt anybody. But there's a question as to, well, who's responsible? Because somebody slipped and maybe they broke their hip and they had to go for surgery and they had to have their hip replaced. and now they have stitches all up along down side of their leg. So the company, it would be argued that the company is negligent, that the company is responsible. They were careless. They should have had somebody watching and mopping up the floor. Now, the other side of it is you would argue that it was an open and obvious condition, the floor was wet, you knew, you yourself should have been more careful. So there could be some liability on the part of the claimant as well. But that's an example where the company is responsible, and they're not going to come and take your house. They're not going to be able to pierce the corporate veil, because that's the reason why you get incorporated, is because you know that things happen and that you need to be protected. You're an investor in a company. Why should you be punished because of your investment? Which in many cases, it's a passive investment. You're not actively involved in running the business. So if we have stock in Procter & Gamble, what we send Yusuf down there, and what he's running the Charmin business segment, or Crest, we're not involved in the running of the business. It's a passive investment. So if somebody buys Crest and it damages their teeth, then why should the shareholders be responsible? So the company, though, would presumably have some negligence, that they sold a product that was defective. So that's the main advantage of incorporating, is that you have limited liability. That's what limited liability means, that us as investors have limited liability. So that's a huge advantage, because as a sole proprietorship, that's not the case. You have unlimited liability if you own a sole proprietorship. So it would make sense that you would incorporate, because it's inexpensive to do. We're talking about several $100s for the fee, and then I'm going to prepare it for free anyway, so how could you go wrong? And then, but they charge you for everything, the Department of State. They charge you for the application for incorporation. That's one fee. If you want to file for doing business as, so if our, let's say that our business is the Brooklyn Academy of Food Service Corporation, let's say that's the name of our company, then we might want to have something that we use on a daily basis to promote our business. Another name, like Khalil's Roti Shop. Right? That would be better than the Brooklyn Academy of Food Service Corporation. So you need something, that would be a doing business as, that would be a DBA. They charge you a separate fee for that. They charge you a separate fee if you want expedited processing. So if you want to get your certificate of incorporation quickly, they could do it in 24 hours. You have to pay a fee for that.
60 bucks.
48 hours, you got to pay a fee for that. So there's quite a few fees, but the fees are less than $500 at this point in time in New York. And, you know, they changed the fees, they raised them, but just to give you an idea. And then if you're going to pay somebody to prepare it, that's separate. But that's the fee. So the government, really, what that tells us is that the government is actually encouraging people to incorporate. They're making it feasible. If it was $5,000 to incorporate, then you say, well, we know that the government doesn't want us to do this. because that becomes a barrier. You're a small business, you're opening up a shop. Where are you going to spend $5,000 to incorporate? Now you might still think it's worthwhile because of you're concerned about the unlimited liability. But most of the times, people would think that that's quite exorbitant. But for less than $500, certainly it seems very feasible. So that's the main disadvantage is the double taxation. The main advantage is limited liability. And then, if we file that form with the IRS, we could get S-Corp status if we have 100 or less shareholders, and then we could avoid double taxation.
Is it possible like you could get limited liability for like a partnership or something like that?
Yes.
Or sole proprietorship?
Well, not for sole proprietorship. A sole proprietorship is an entity choice, but by the nature of that business structure, you have unlimited liability. That means that you're just, you're operating the business and you're personally responsible for any debts of the company. Which in some cases, that may not be an issue when business is going well. You buy inventory, you sell inventory, the money that you collect as revenues, you pay to your suppliers, but then you have other expenses, and sometimes your expenses exceed your income. And then that's when it becomes an issue. And then that's when you have people chasing after you that says, you know, we shipped you all this food, and then you never paid us. And you sold all the food, but you also spent all the money. So then that becomes a problem. So they give you a line of credit up to a certain point, but then at some point they expect you to pay. So you're one of their accounts receivable, but that doesn't mean that it's an indefinite loan. Accounts receivable on a company's balance sheet is considered to be a current asset and something that is easily converted to cash. So that means that you could expect to receive payment in a short period of time. Sometimes what companies do is they factor their accounts receivables. Anybody know what that is? What does it mean if we factor our accounts receivables?
Into the amount of money that you're going to receive at the end of the month, so it kind of increases your revenue.
And so what is it they do? I missed the first part.
You just like calculate it into the total revenue that you're going to receive.
Interest?
When you factor your accounts receivables, what you do is you sell your accounts receivables to another company. So basically, whatever money is owed to you by other people, you sell that to a financing organization, and then they collect the money. And now, of course, they do that for a fee.
Yep.
But the advantage to us would be, as a company, is we have, let's say, $100,000 in accounts receivables. People owe us money. So a financial services company might suggest, well, we'll give you $90,000, and then let us worry about collecting the money. So you figure, well, 90,000 is less than 100,000, but 90,000 is more than zero. So you might decide to do that. It might be practical to do that. And isn't that what's happening when we use a credit card? That's an example of factoring. Because you go into Target, for example, and you use your MasterCard there, and what's really happening, in that split second, we go in there, and we're telling Target, we don't have the cash to pay you right now for this merchandise. So what happens? The MasterCard says, Target, we're going to pay you. But we're going to pay you 97%. And what's going to happen is we're going to pay you 97%. You don't worry. That's it. You got 97%. And that's a realistic number for credit cards, for MasterCard, for Visa. American Express usually tries to get 5% from its vendors. But they pay Target 97%, and then 100% they expect to collect from us. And that 3% is their gross margin, that's their profit.
What's the interest?
And then usually where they really make money is when you don't pay them, is then you have to pay them 22% interest. So sometimes they're happy if you don't pay them, as long as they believe that you can pay them, but you just haven't paid them. You see, that's the difference. So if they believe you have the ability to pay 22%, then they're more than happy to take your money. But the problem is at 22%, it's almost like you would never be able to pay them off. Because, I mean, that's a substantial amount of interest, and then you couldn't pay them what you owed them in the first place. Now it's 22% more. Well, if you couldn't pay them before, you're not going to be able to pay them now.